Welcome to Accounting in the Wild, where we'll discuss various subjects in the tax and accounting world, also featuring tales from the field and interviews on various tax and accounting subjects. All this and much, much more on Accounting in the Wild. And now, here's your host, Jason Dynison.
Welcome to this episode of Accounting in the Wild, brought to you as always by MyCPE1 to earn CPE credits for watching or listening to this podcast. Head over to my-cpe.com and continue your professional learning journey. Our guest this time around is Randy Eickhoff with Acena Consulting. Randy will always have the distinction of being the very first guest on this podcast, and now he's back to talk to us a little bit about Section 179D deductions and a lot about cost segregation studies, what they are, who they benefit, and there's still time to even get one done for 2024. So let's get right into the show with Randy Eickhoff, brought to you by MyCPE1. Let's start with 179D because that kind of flows into cost segregation. I think most accountants and tax pros have heard of Section 179 deductions, but sometimes those other things under 179, it's like, hey, wait a minute, what are we talking about here? So first of all, before we talk about your service that you offer about that, let's define just what is 179D.
Yeah, in its simplest form, and Jason, this has been around for a while. It's just gotten better with some of the more recent tax acts. But it is essentially an additional deduction for a building that is rated as an energy efficient building. And what's really cool for companies out there is that it's available not only for commercial buildings, but also residential buildings that are 3 stories or greater. And if that's not enough, and don't you wish it was, public buildings are also eligible, but since public buildings don't pay taxes, you can actually take that deduction and assign it to the designer of the building, and they can take advantage of that deduction. So this is something that is really available to a lot of people. If you're meeting a prevailing wage requirement, which is something that's come in more recently, you can get up to a 5 times benefit, up to $5 a square foot, and it is indexed for inflation, so that goes up every year. So for 2025, I want to say it's $565 a square foot. Those numbers can add up and bring some significant benefit for companies.
So this is now the first time we had you on, we talked about research and development credit. This is a deduction, not a credit, but some of these numbers can be pretty large, right?
Well, they can. And so let's break down those public buildings versus the ownership. If you were a building owner and you're eligible for this, and I'll give you an example. One of our clients, we talked about right before we started this, over $100 million apartment building. We did the analysis for them. Because of the timing of when they took their building online and started construction, there's a little bit of a window where you can get that 5x benefit without having to meet the prevailing wage requirements. And they actually fit into that window, right? So they started construction before the law was finalized and then finished after. So they fit into this window. Anyway, their deduction was an additional $1.8 million. Now, it's a deduction, and it's just like depreciation. So they're going to have to recapture that at some point in the future. However, for a public building where they assign that deduction over to the designer of the building, it becomes a deduction, but they don't own the building, so they never have to recapture it. So that becomes a permanent tax difference that they're going to get to take advantage of.
That's pretty
Cool.
significant savings. Yeah. So now I know in that conversation we were having offline about this, there's something about an engineer right? What is that part of the provision?
Yeah, part of the IRS requirements are that the analysis has to be done, I believe it's using a Department of Energy software by an engineer familiar with construction engineering and how this whole process works. And you get the deduction when your building, when compared to a model building from 2007, and they map out the energy for the two buildings. If you have a 25% or greater efficiency in your building in three areas, that's going to be the building envelope, which includes your windows and doors, your HVAC system, and your electrical system, so LED lighting, things like that. So when they make that comparison, if you've got a greater than 25% better efficiency building, you're going to get that deduction all the way up to 50%. Now, back in the day, when this first came into play, it was $1.80 a square foot, and you got 60 cents for each one of those components. Today, the laws changed, and they just analyze all of them together to see if you can match that 25%. They don't take them separately. So it's a little bit easier from that perspective, but it still has to be done by an engineer that's familiar with this and has some background.
So your firm now does this analysis, and so this would be, is this separate from cost segregation, or is it kind of rule? I guess it's all related, but it's a separate service, right?
It is, and it's actually all three of the services we offer kind of connect to this. So let's connect those dots.
Yeah.
So the typical way to do this, right, is for cost seg. If you're going to go out and do a cost seg study, not going to be available when you go buy the building. But if you did some significant renovations to one of those three areas, then you can take a look at it for the cost of those renovations. If you construct a new building, very much available, and typically you're going to get something for that. So when we're doing a cost seg study, pretty easy to go in and say, wow, you just built this. Let's look at 179. There's no charge to evaluate it to see if you're going to qualify. But then let's take it to that next level. If you're the architect that engineered, that designed that building, and it's a public space, a school, a city building, well, now you can take advantage of that if they're willing to assign that deduction to you. But in addition to that, you might get an R&D credit for some of that design work for the building. So there's a connection to R&D as well. So it's kind of fun to be able to offer all three of those as related sort of service lines.
So we talked the first time we had you on here, you talked about the R&D credit. We just talked about 179D, and we both have referenced cost segregation. Let's come around to that then, the third piece of the stool, I guess, the third leg of the stool. What is cost segregation?
Yeah, and this is the oldest of the three, right? This one's been around for a very long time. But essentially what we're doing with a cost segregation study is we're taking a building that is owned by a real estate investor, it can be commercial or residential, and we're separating the structure from the personal property that is inherently part of that property. So we're talking about asphalt, concrete, we're talking about furniture, we're talking about flooring, we're talking about all those pieces that are going to wear out much faster, that can be depreciated over a shorter lifespan, 5, 7, or 15 years. And again, that's a deduction. So you're ultimately going to recapture that at some point in the future, although you can defer that tax with a 1031 exchange. You can will it to your kids and maybe never have to recapture that. So there's some tax strategies around being able to do that. But it's a way for a real estate investor to lower their taxes and have more money to then invest in a new opportunity, use higher cash flow. And it's been around a long time. This is not an aggressive strategy, but it's one that a savvy investor is going to take advantage of every single time because they're going to increase their cash flow.
So basically, if I go out and buy a building and I'm going to rent it, and now let's back up. Let's back up. Is there what would kind of be the starting point where someone would want to look at cost segregation? I know everybody would want to, but realistically, is there a level? I know you mentioned real estate investors. Is there a level of purchase price or income or whatever where it's like, yeah, you should be looking at this?
Good question. There's actually a lot of factors that need to be looked at. Most people, for the CPAs, most of the folks that are going to be watching your podcast know that you can't use passive losses, rental losses against active income unless, right, you're a real estate professional. You meet that designation. So that's going to come into play. If you've got a client that is a taxpayer, they're out buying their first rental. Let's put it in the Midwest somewhere for $300,000. We can do some work for them at a price point that's going to make sense and generate some savings. But if that property isn't cash flowing, really not going to have a lot of benefit for them. So really need to do some front end work to say, is this going to be beneficial? If you've got a spouse that does meet that designation, that changes everything because now that can be available against some active income. So a little bit of complicated stuff. So it's not as simple as when does it make sense? With that said, though, I was at a networking event and was chatting with a CPA, and he said, I've told my clients, unless they are building is at least $750,000, the cost of doing the study doesn't match the benefit. It's just not going to be worth it. I said, well, let's talk about that because we have a service line that allows us to do this at a price point that does make it beneficial. Now, this is we call it an Acena Lite, and it is a statistical analysis built off a foundation of thousands of full cost segs. It does not meet the IRS criteria for a quality cost seg study. However, the methodology from a statistical analysis is valid. It includes audit defense, so we go and meet with the auditors to discuss with them exactly how we came up with those numbers. Important at this point, Jason, to mention, there's no requirement in the Internal Revenue Code that you do a cost seg study in order to break out that depreciation. There's no requirement to do it. So this analysis does that. It is going to give you essentially the same results as a full cost seg without having to do a site visit and everything else. Again, doesn't meet the IRS criteria in the audit techniques guide for a quality cost segregation study, but that doesn't mean that the results under audit, if we go through and explain that methodology, the auditor is going to push back and say, I'm not going to accept this because they're going to be very close to a regular cost seg study. But that allows us to go back in and help that real estate investor that bought a $150,000 home that they're now renting out and able to, start that real estate portfolio as they build their investments.
So let's come back later to the IRS audits, but talk about first, let's go back to the example that I had started on, and then I said, let's back up.
Yep.
So I go out and say I buy $1 million property, either a residential, maybe an apartment complex or a commercial building. There's stuff that comes along with that building, right? I mean, some of it, I'm guessing keys to like IRS unit of property regulations and things like that, where like the windows are a unit of property or the elevator systems are a unit of property and that sort of stuff. And so you're just breaking out. I mean, it's not just this is the dishwasher and the washing machine,
right?
Probably that too, but it's also, I mean, this is all the units of property and the associated depreciation period on those pieces of property.
That's correct. And in a full cost seg, when you start looking at things like, let's just step outside the building for a second. If it's commercial, let's take that apartment building, you're going to have a parking lot that's probably covered in asphalt. Well, that's a site improvement depreciable over 15 years. And if bonus depreciation is in place, you're going to get all of that in year one. Right? So that becomes a very big number. The sewer lines underground, those are site improvements. And the engineers will break those out, even though I can't go look at them. They know they're there, right? We know there's toilets and we know there's water and we know that all of that infrastructure, that analysis will get done at an engineering level, and that becomes part of that personal property we can extrapolate from the building and be able to take additional depreciation on.
I saw something on LinkedIn the other day. There was a discussion of how beneficial are cost segregation studies because you just have to recapture all of that when you sell the property. So I know this is more on the tax pro accountant side of things, but
Mhm.
let's talk about it, because one of the things that I thought was, a lot of times the deduction now is time value of money type of thing. It's a lot of times better to have that deduction now.
Right.
And I guess, but I'll ask a question. You do probably need to hold the property for a while, I suppose, in order to really make something like accelerated depreciation under a cost segregation study worthwhile. If your idea is to flip the property in a year or two, it's probably not so
Right.
worthwhile.
It really depends on what you're going to do with that money, right? So there's going to be a cost. And let's throw an example out there. Let's say that we've got $1 million of additional depreciation. Okay. Now the tax on that in California, federal and state combined, we're gonna assume a 40% tax rate. That's a $400,000 deferral of tax. So the question becomes, after you pay the fee for the cost seg study, right? You're going to be out of pocket that money. You're going to have a bunch of that for almost $400,000 left. Now, if you take that money and go buy something else, you're going to get a return for your investment. The question becomes, is that return on those dollars higher than if you just paid the tax today? And the answer is probably going to be yes. So that's what this again, that savvy investor is going to look at. They're going to say, here's a chunk of change. I don't have to write the check for to the IRS. What can I do with that money? What kind of return am I going to get? And does that return outweigh the cost of the cost seg study today, as well as time value of money? And if the answer is yes, why wouldn't you do this?
Well, and the other thing that happens when you get extra deductions is it could, depending on your other income and such, your adjusted gross income
Yep.
could be reduced to a point where maybe you could fall into the category of being able to make Roth IRA contributions,
Right.
or it becomes better to do a Roth conversion, or all
Yeah.
these other things that kind of key to AGI and income and such.
Yep.
It all brings those things into play suddenly too.
Well, that's the value of having a great CPA, right? They're going to look at all of those components and be able to give you some advice. But the biggest challenge that I find with a lot of taxpayers and early real estate investors is they don't know what they don't know, right? They don't know the questions to ask. So having a CPA that has that experience and can really advise on that to say, well, when you do this, this thing over here happens that you didn't think about. Oh, well, that's a completely different, that changes the game completely, right?
Yeah.
And so on real estate investing, one of the other components that people don't really understand and sort of mentally think about is, I call it the trifecta, right? You're making money three ways. One of them is in most markets, you're going to see an appreciation. So while you hold that, you're going to get a 3, 5, 7, 10+% every year on your money on whatever that investment is. That's number one. Number two, you're going to save money on your taxes because of depreciation. And so you're not paying tax today on that. So that's number two. And then number three is somebody else is paying the mortgage. So you're not paying the mortgage. So you've got three ways to make money. Show me another investment that doesn't work for. And so that's the good news. The bad news is if you pay too much in a bad market and not charging enough rent because the market doesn't allow it, it's going to be a very bad investment. So understanding cash flow and all of those components and having a great CPA that's going to help you through that process, you got to have it. That becomes the winner, right? That's your hero. They're going to be able to give you those kinds of numbers.
Yeah. So you've done a cost segregation study, you get some extra deductions that allows you to do other things with your money. And then the IRS comes calling a few years later,
Yep.
wanting to check out what you did. What are some things that the IRS is going to look at in an audit of this?
Yep. So they're going to look at how you developed those components of personal property. So if you've got a $10 million building and you've broken out 5 year, 7 year, and 15-year property, the question is, how'd you come up with those numbers? And if you've got an engineering based study where someone's gone on site and confirmed and validated that these assets exist on this property. You've measured all of the rooms. That gives the IRS a lot of confidence that those numbers were developed in an appropriate way versus, you go out and buy a building and say, I'm just going to take 25% of the purchase price and I'm going to throw it over into personal property and we'll break it out. And there's really no validation behind it. And I can't tell you how many I've looked at that have been sent over to me where they never took land out of the overall purchase price. So that's one of the things the IRS is going to look at right away is, did you pull land out of your purchase price? And what's the value of the land? How did you come up with that? Did that come from property tax records? Was there an appraisal done? Did you get some sales comps when this was done? And that becomes that can be a little bit contentious and a little bit difficult. So you want to make sure that you've got a reasonable land value because the IRS is definitely going to push back on that one.
So, what else do we need to talk about on cost segregation studies, Randy? I feel like we've covered a lot of ground here in about 20 minutes or so. Are there any other thoughts on your side on what you'd like people to know?
Yeah, I think the most important thing is to do the homework, right? Again, we can generate a nice tax savings for a company doing a cost seg study for them, but can they use that today? So if they know that we generate, $1 million in additional depreciation, that's could save them money today, could be tomorrow or the next year, depending on whether that property is in a cash flow positive situation. If it's not sure that it makes sense to spend the money to do that. So I would just really encourage the real estate investors on your podcast to do their homework, and the CPAs, if you've got clients that are looking for ways to save money for retirement, you know how to do the cash flow analysis. That's why you're a CPA, is take the time to do that for them. You're going to be the hero ultimately because you're going to help them to get into an investment that's going to be very beneficial. And most importantly, you're going to do the homework. What are market rents in that particular market to make sure this thing's going to cash flow. I've owned a property in Hawaii for more than 25 years, and it hasn't cash flowed ever.
I think that's the experience of a lot of folks who own the one-off properties. I know I don't anymore, but I own one property and it's like it was kind of a money pit. But it was the first
Yeah.
house I ever bought, and then I moved when I got married. And so it was like, well, and it was in the '08
Okay.
financial
Oh,
meltdown, so the
yep.
house couldn't sell, so it's like,
Right.
I guess I'll rent it out. I'll tell you,
Yeah.
it was a happy day when that property sold. So that's getting sidetracked, I guess, from our discussion of cost segregation stuff, but it kind of does relate to it, though, that
It
if
really
you've got
does.
that one-off house that is the money pit, and you're not a real estate
Right.
professional, so you're either limited to the $25,000 deduction each year, or maybe you don't get any if your
Right.
income is too
It's too
high.
high, right?
A cost seg probably isn't for that type of
Right.
person most of the time.
Yeah, that's probably right. And I think that again, homework is key, right? Having the knowledge and the education, if you're going to get involved in real estate, is critical to the overall process. And I would say that, look, I know when I bought this property, we looked at rents and we looked at the pricing and you try to be conservative, but at the same time, you're excited, right? You're excited to buy this. You want it to work. You want to figure out a way to make that cash flow work for you. But really taking a very conservative look and saying, what's worst case scenario? What if I can only get the minimum rent for that marketplace? Now, does it still cash flow? And then if it does, then let's look at a cost seg study so that we're not paying any tax on that bottom line income that's coming across. Let's defer that tax out into the future so we don't have to worry about paying it today.
One other question that popped into my head is, can you do a retroactive cost segregation study and then catch up on Form 3115 in the current year? I'm guessing the IRS would probably say, "Hey, let's take a look at this." What do you say on that?
Yeah, no, the answer is absolutely you can if you haven't
Okay.
done one in the past. Now, it's important to note, though, that whatever tax rule was in place when the property was placed in service is the tax rules that you have to go by. So maybe it's 2024 and you decide, I want to do a cost seg, I've got some tax I want to try to defer. And I've got this rental property that I bought in 2022 when 2022 we were at 80%
I believe it
bonus.
was 80%.
Yeah. So you're only going to get 80% bonus depreciation versus 100%. And that's okay, but just know that going in. So if you went in service in 24 and you're going to do your cost seg in 25, when bonus depreciation hopefully will be back at 100%, you're still going to be stuck at that 40% level. So just a word of warning to make sure that you pick those up. But to answer your question, Jason, it's 3115 is the form number. It's a big catch up of all the depreciation that you've missed, can be a huge benefit.
Mm-hmm.
And then the other piece that a lot of times will get missed on a cost seg is if improvements have been done, that probably means there's been some disposals that should be picked up as part of that study. And so when we go in and visit that building, we're going to look for those disposals. If somebody retrofitted their kitchen and did a huge kitchen improvement project, well, hopefully there's some before pictures, but we're going to try to detail out what was disposed of. And that's going to be in addition to that regular depreciation you're going to pick up on a cost seg, which is really going to supercharge the overall benefit.
So you have a team that does this. You have engineers and people that you partner with on all of this for both the 179D aspect and the cost segregation. Well, and I suppose the R&D credit too, and engineers are needed for that too sometimes.
Yep. Yeah. All the R&D we do in-house, but the cost seg and the 179, we outsource the engineering component. We do the site visits. I was actually on site in Washington Monday at a property just because of the timing. I needed to be the guy that went out. And we've got a big project coming up in a couple of weeks down in Orange County. I think we're going to bring 3 people on site just because it's that big and we want to get through it very rapidly. So we do the we do the site visit and we do the legal analysis to assign class lives to all of the assets. And then obviously we're there and available for the client in the event the CPA, the IRS comes knocking for him.
So Acena, you've been doing this a long time with Acena, 20 years on the R&D.
You'd never know it by looking at me, right? Yeah, we've been doing this a really long time. I've been so I guess I started my career in '88 at Arthur Andersen. So been involved in tax for almost all of those times since then.
How many cost seg studies do you think you do at Acena in a typical year?
Last year, last year we probably did about 75. Yeah, there's a lot. Some of those were the smaller ones, some of those are larger ones, but it's a thriving practice. It's been growing every year. I'll tell you that the beginning of this year, everything stopped. People have been waiting for the tax bill. And now that they've seen where it's going, in the last 2 weeks, we've had, I think, 10 or 12 new studies that have come to us to get benefit analyses that we're now getting out to visit those properties.
So if someone's listening to this and they want more information, if they're watching the YouTube video, you could see Randy's LinkedIn profile link on here, but Acena Consulting, what's your website? What's your contact info for people who would like more info?
I appreciate that. Acena Consulting, one word. And I think on my profile here, it says Acena somewhere. Oh, I guess it doesn't. It's ACENA consulting.com. And then the office line is 805-426-9669. And we're super responsive because we know that timing is critically important. And then I guess just as a reminder, the engineering component on these cost segs takes 4 weeks. So if people need this for the coming the extended tax deadlines, you probably want to reach out pretty soon because after document collection and that front end analysis, it's going to take some time to get out to the property and get that piece done. We got to do that quickly.
That's a good point, though, that this is going to air right before the 4th of July. So there is still time, I guess, for a 2024 acquisition, right?
There is.
If you're on extension.
Absolutely.
Yeah.
Yep.
Well, great. Randy will be back with us in a few months talking about research and development credit audits, and if anything has changed over 2025 as far as rules and such, we can talk about that too. But Randy,
the better question, Jason, is going to what hasn't changed.
well, that's true, isn't it? It's going to be a good year for people like me who do a lot of the teaching and presenting on stuff, because
Right.
we'll have plenty of things to talk about.
That's true.
So,
That's true.
All right, Randy. Well, thanks so much for joining us, and we'll be talking to you again soon.
Thanks, Jason.
Accounting in the Wild is brought to you by MyCPE1. To get CPE credits for listening to or watching this episode, head over to my-cpe.com. Until next time, I'm Jason Dynison saying so long for Accounting in the Wild.
Thanks for listening, and join us next time for another edition of Accounting in the Wild with Jason Dynison.